joined today by Brad Case, NAREIT's Vice President of Research and Industry Information. Brad, REITs continued their rebound in November, beating the broader market. What's fueling this surge?
Yeah, the rebound has been pretty impressive. REITs are up 100% since their low point in the early March of this year, and in fact, equity REIT investors have gained almost 107% from that low point. It's been a very strong rebound, and what's really fueling it is investors' expectations that going forward REITs are going to be able to acquire very high quality property at very, very good prices, and that REIT investors are going to see very strong returns for probably several years to come.
And we're hearing a lot of bad news about the broader commercial real estate market. How do REITs fit in there?
Yeah, in fact, there's a big question about whether real estate is, as they say, the next shoe to drop. And I think what we've found is the beginning of some differentiation in the market. REITs tend to own high-quality properties, and it seems as though there's evidence starting to come out that that part of the real estate market may already have hit its bottom and may be starting to move up in terms of property values. Of course, REIT investors have been responding to those stronger property values for months now. Green Street Advisors, which is one of the major REIT equity analyst firms, came out with a report just recently saying that they believe that the high-quality part of the market that represents properties owned by REITs already hit its bottom and is on the way up. That's not really probably true for the lower quality part of the market that tends to be owned by private real estate investors. So there still remains significant concern over there.
And recently we've started to see some light at the end of the tunnel for CMBS. What's your outlook there? Do you have expectations that we're going to see more CMBS deals?
Yeah, we thought that the federal government would work very hard to reintroduce liquidity to the commercial real estate debt market, the CMBS market, and those efforts seem to be paying off with some very important deals being completed very recently. I think going forward it's likely again that the high quality commercial real estate debt which tends more strongly to be owned by REITs than by private real estate investors, is really going to be helped by by those federal government efforts going forward. The other parts of the commercial real estate debt market maybe will continue to experience some weakness going forward.
And continuing to look at 2010, what are the major factors that you think are going to have an impact on REIT performance?
Yeah, I think probably the major factor is the health of the banking and the financial system, but maybe not in the way that one might expect. Banks and financial institutions are holding a huge amount of bad debt that's secured by commercial properties that mainly private real estate investors bought at the height of the debt bubble and the asset price bubble in commercial real estate. So far, the banks have been willing to, as they say, pretend and extend, which means extend the terms of repayment on those loans by pretending that property values haven't come down as sharply as they really have. When the banking system becomes healthier, then the banks will no longer be permitted to pretend and extend those loans, and that means those properties will come onto the market. REITs are sitting on the ability to access the capital markets to pick up those assets when they come available. So the real key is when the banking system becomes healthier, the properties will be available for REITs to scoop up, and that's really the key to very, very strong returns going forward.
Great. Brad, thank you very much. For REIT.com, I'm Matt Bishar.